Hello, I'm Stephen Galpin and welcome to Property Matters. Today I've got with me Jamie Pritchard, Director of Sales for Glenhawk, who are property finance providers, and we're going to have a talk about the prospects for finance in the property market with these special circumstances that we have today. So Jamie, welcome to you.
Hi Stephen.
Well, quite worrying times in the property market at the moment. We have a government that seems to be flip-flopping about their policies. We're going to have no-fault evictions, and then we're not going to have no-fault evictions, and now we are going to have no-fault evictions.
Yeah.
We're looking at scrapping of targets for building apparently this morning. I don't know what quite the logic of that is, but there we are. But this must be very worrying times for your developer clients.
It is worrying times because it's turbulence, isn't it? And developers don't like turbulence. You know, if we go back a step, you know, we've got a cost of living crisis going on, which I don't think any of us have felt yet because the heating hasn't fully been on yet, or the bills haven't come through for that. We've got everything that the government have done, which through their mini budgets, which I think is, the word mini is quite ironic because it was anything but mini. The effect that it has.
Seems to have crashed the economy, doesn't it?
It seems to have had that effect, you know, to a certain respect. But this is not compared to 2008 in my mind. It's not those times, but there's a lot of things that are similar. So to answer your question for developers, there is a lot of fluctuation because the cost of funds has gone up because the base rate has actually increased now, which means that different lenders like ourselves who are funded in different ways, the cost of funds has gone up. So that means the interest rates are going up, and we also got the cost of materials are going up, and we've got all new rules coming in. So yeah, it is worrying times for developers, but I'm very positive, half, you know, glass full sort of a guy. But so I still think there's a lot of opportunity in the market, but we do need to come out of these turbulent times so the developers do know what they can do. Can they exit from the loans that they're on at the moment? Can they sell them?
But I think one of the fundamental problems for people looking from the outside is they often forget that you as a financier have to get your money from somewhere.
Correct.
And of course, what you're doing is sort of going to the casino a little bit, aren't you? Sort of.
No.
Well,
it's a bit more structured than that, Stephen.
A bit more structured than that, but worrying about where you're going to get your finance from, what the long-term costs of that are going to be for you to then pass on to your clients. I mean, it's got to be well balanced, hasn't it?
It has got to be well balanced, but it also needs to be well considered. So this is where due diligence really comes in from the developers, because developers, that's their job. They don't want to just shut up shop. They're not going to go and do another job. They just need to be a lot more considered. So on funding, I think this is the time if you're utilising a broker or going direct to the lender themselves, you really need to understand how they are funded.
Yes,
so are they actually able to progress and complete on the deal itself? Because there's loads of different funding models out there. It's not casino, as you said, but there's warehouse funding, which is institutionally backed funding through, you know, the likes of JP Morgan and NatWest, or you've got high net worth family money, you've got forward flow facilities, and actually all those different, and understanding those areas means the difference between whether a lender wants to fund the deal or not. And you could be money deep into that, couldn't you?
Yeah. Well, I can think of an example going back to the 2008 situation. I can remember actually buying a property from one of the big banks that they'd repossessed, and they'd repossessed on the basis that they'd forced a number of their clients, their borrowers, to revalue their properties. So if the values came in below what the bank was prepared to run as a margin, they were saying either you put cash in or we want the loan back. Now, I presumed at the time that was because the bank will have made a commitment that wasn't long-term enough to cover these sort of shortfalls and securities. But it seemed grossly unfair that somebody had taken out a contract, got a loan facility, thought they'd got it for a period of time, but in effect hadn't because circumstances changes. And I'm just glad that I think we are a little bit more sophisticated now in that. But your point is, as you say, you've got to know that your funder can maintain the facility being offered.
Can maintain it, can service it after the event as well, and also understand what your rate that you're getting. So that seems quite clear. You know, you'd say, I'm either getting this per month, 0.7, 0.8% per month, but actually read the fine print. Is it a fixed rate? Is it a variable rate? I'm not saying that either one is bad, but actually could that fixed rate, if base rates jump, actually migrate into a variable rate as well with certain collars they put in place? Understanding that with your legal team and where it could be, because imagine if your rate goes up during the term, well, then your profit goes down potentially, doesn't
Absolutely,
it?
yeah.
So it's really about exit routes.
And your exit becomes more limited, doesn't it?
Well, the exit's limited in certain ways at the moment, but it's not all fully off the table. So when you're saying about 2008, there's a lot more regulation since then, but there's a lot more prudency, there's a lot more understanding, and we want to build up businesses as a collective, repeat business. So we're not just in it for the short term, we're in it for the long term to build up those relationships. But the exit routes, let's go through quickly what they could be.
Okay.
Exit sale. Well, that's good. But have we got the ability to actually got the people who are able to buy that with affordability, cost of living, and everything else, and building a deposit, and then the funding, and the bank's affordability? Are you able to get the funding that you want? Is it actually to exit to a long-term solution like a buy-to-let funder? So you've bought a property, you want to do it up, or you've bought it because it needs to be a quick purchase through auction, and you want to exit through refinance. Well, the stress tests have gone flying up because stress tests are linked to the interest rate. And if the interest rate's now around, I don't know, an average of 7% on buy-to-let there, rent only has a ceiling of the ability of how much actually you can charge for the rent, but you need to hit that. So if you're not hitting that, you're not able to actually create and gather the loan amount that you need to get out of that loan.
Well, and you also need to hit it with a good margin, don't you?
Well, you do if you want to make profit as an investor. So back to your first
point. If you want to be around for the number of years, I guess.
But I still think there's opportunity there. And I think there's a diversification now of what your portfolio and the type of asset that you're going to be buying. Yeah.
Jamie, I know amongst your sort of portfolio of products to lend out, you do an amount of, what shall we say, transitional funding.
Yes.
Which is by nature relatively short term.
Yes.
Are you finding the take up on that is great today? So people are taking out short term finance to wait for all this melee to settle down a little bit and then look for the longer term relationships?
We are actually. So since the mini budget and before that, we have never been as busy as a market, and actually new people who understand that. So we've had a massive drive on education in the market of why transitional short-term finance can actually benefit you. But you're right. I think in this turbulent market that we talk about, people are probably hedging their bets at the moment and thinking, I think it will calm down in 2 years' time. Now, we both haven't got a crystal ball and we don't know, but you would imagine it will have calmed down to some level where they're doing that short-term funding to allow themselves more variety of exits in 2 years' time.
Yeah, okay, that's quite interesting, isn't it? I mean, I think one of the problems that we've always had in this country is the fact that even on what the banks would term a longer term loan, it's relatively short term. The thinking is relatively short term. Very rarely do we plan for the longer term future. I mean, I'm just looking out the window now over Canary Wharf, and I'm thinking when Olympia in York first started to build this, the bank bust them in, I think, the first 6-8 months of construction.
Yes.
It'll never work, they said.
Yeah, and look at it now.
And look at it now. It's the hotspot in London, isn't it? So do you think we're going to have to adjust our thinking in the financial institutions? And do you think they will?
Oh, there's two different questions then, isn't there? I think that we have to, because we always, if I'm creating a product, I need to be thinking about the longevity of that product and how much take-up it's going to be. But people are now living differently. So you're going to see a massive uptake on HMOs with affordable rent. Are they able to actually, and is there enough houses for people to rent? So different way of the generational of people who maybe want to live in a multi-unit HMOs. So that's an opportunity for investors. But then lenders create products for that. We just mentioned one a moment ago, which is, can we develop more products which are more focused for 2 years, which are commercial type of propositions that can then go into commercial term in 2 years' time when there's potentially more options. So we're always developing new products. Do I think that we will? I think the industry does, because lots of lenders won't want to see other lenders stealing the march and taking away maybe a smaller cake of opportunity, but can you actually still satisfy what your targets are going to be through those different types of products?
Yeah, complex.
Well, the area of finance I'm in is known as complex finance. It's complex specialist finance. All that means is it's not your high street institutions that you used to go with a suit on, like yourself, Stephen, 25-year mortgage.
Right.
Everything's changed now, whether that
Yes.
be understanding of self-employment's changed, contractors, whether that be the different types of properties that you now want to build under modern methods of construction. There's lots of things that are changing that we specialist lenders keep up with.
Just on a retail basis, I mean, when I was young and I first bought my first house, you'd go along to your building society, and the manager there would probably know you better than you did. He'd know your area, he'd know your employment prospects and all the rest of it, and he'd perhaps give you a little chit with a sort of promise of a mortgage in 6 months' time or something, if he could see you save a little bit in the meantime. But of course, when the banks, I suppose it was in the 80s, wasn't it, when the building societies all wanted to become banks and sort of financial trading institutions, selling everything else probably other than mortgages, it changed, and we lost that specialist type of lender, didn't we? And ever since then, it struck me that we've always been a bit vulnerable to the sort of vagrancies of the bank's policies at the time.
No.
You don't.
So I don't agree with you in that sense, because I think we can look at the rose-tinted glasses of I know the building society manager who knows me better than I can, and they'll lend on it. But we're talking about a different environment now where the property prices have gone flying up. You're putting people now who are taking a mortgage, at potentially 5 times income of hundreds and hundreds of thousands.
Mm-hmm.
There is a lot more lenders now that can do the specialised areas that maybe your banks can. So I think there's a lot more. The lenders have to be better. Lenders have to be better, and they're always looking at the next opportunity, whether that be buy-to-let, residential, but the regulations have come in as well to help out. So whether that be, I always say about if a customer comes to me and an application comes in, it's like they stood in the middle of a greenhouse and I can see each side of them, even if they've not told me that, whether that be credit reporting, whether that be money laundering checks, whether that be fraud checks. I know about that customer, just like your building society manager possibly did. So I would suggest that the market is really good like that.
Okay. So you don't regret that loss of sort of specialist lender?
I think specialist lenders is really the benchmark of the industry now. So you have got your high streets banks and building societies, as you mentioned, but specialist lenders, how much business they're actually writing in the market now, I think that's gone way past 40 billion just for buy-to-let and residential. So, that's covering stuff like adverse, and guess what? Adverse, people sometimes have got blips on their credit file, potentially through COVID if they've lost their job. It doesn't mean that they've got bad credit in their DNA. It's just that can you lend on that? Some high street banks won't. So that's where a specialist lender comes in for just that. Buy-to-let in itself has become the most specialised area. It's actually flipped on its head, where the high street banks used to do it, but because of all the regulation that come in post 2016 and the tax changes, that is now a specialist product.
Okay. Well, on that note, we're going to go to the commercial break. We'll be back after the break with Jamie's views on the financing of the property market, and I'll look forward to some more conversation on that subject. Join me again shortly. Hello and welcome to part 2 of Property Matters. I'm Stephen Galpin and I'm talking to Jamie Pritchard, Director of Sales for Glenhawk, who are finance providers. Jamie, we've talked in the first half about the differences of finance, long-term, short-term, the effects of both, being sure that your financier can actually, I suppose, support his loan to you over a period of time. It's an important factor, isn't it? What does interest me is the difference when we talk about short-term and long-term finance. I understand the criteria are slightly different for you looking at a short-term applicant as opposed to a long-term project. I mean, what are the differences, or what must an applicant demonstrate for those two scenarios?
So I think, first of all, before we say what they need to demonstrate, it's good to give a quick snippet on what they're actually using short-term finance for. So it's either refurbishment projects, buying something that needs to be bought quickly or below market value.
Perhaps at auction.
Potentially at auction. You wouldn't use a long-term funding for that because you're on the hook for your 10% and you need it done in 28 days. But it could be commercial property that needs to be repurposed, so lots of refurbishment, and maybe just a plan in play. So even that you want to buy and then go and execute a plan in play to then move out to development finance or different areas. So what you need to do for that, it all depends on the exit route. So
I was just going to, but the final bit to my question was actually going to be, does it all depend on the exit? And,
it definitely should. So as an industry, if let's give that example, you're buying something at auction, but your exit route is going to actually be sale, which sometimes happens. You're not going to put it in your portfolio, but you just think, I've got a good deal, I'm going to be selling that property. Well, I don't look at income then. I'm looking at actually with the valuer and the underwriter, how long that property will be on the market and what's the average time to sell. So whereas a long-term finance, if you went into your bank and building societies we talked about earlier, they'll be asking for 3 months bank statements and or your pay slips and all that. Well, we wouldn't ask for that in that situation. But we do look, and I think it's really good for a borrower to look at what I call contingent exits. So that's your plan A, but what is your plan B as well?
Right.
So it could be maybe in that sense a refinance. Well, if it's refinance, I'm maybe still not looking at income because lots of buy-to-let lenders don't need, in essence, income itself. So do it with no minimum income.
The product should take care of itself.
Well, it should do, and that's why they build in the stress test to look at it, whether 125% or 145% at whatever the rate is when this program goes out. Wouldn't even want to say what it would be.
Okay.
But you're then looking at actually, can the lender and on the calculators online stress that? So the underwriters are doing a really good job. They're almost trying to get it to the point of they pro-lend, but they don't want you to enter a bridge without being able, or short-term finance without being able to exit. So it needs to be quicker. It needs to be a lot more sort of less involved in a sense from the borrower, because we're not going to be doing, even though we're doing a deep dive and doing all the due diligence, we're only asking for what needs to be obtained.
Yeah, okay, I get that. I suppose the obvious question that comes up with that though is if you get to the end and you're, I don't know, let's say you borrowed something for 12 months, your underwriters have looked at the exit strategy and sort of satisfied themselves that that's reasonable, but let's just say it doesn't happen. Are those same lenders likely to say, okay, then, well, we'll renegotiate, we'll have another 6 months or we'll have another 8? Is that going to happen, or is it going to end in an argument?
Yeah, there's plenty of options of that. And guess what? That's happened in the market. So, you know, we only have to go back a few years. Sorry to bring the pandemic back up, but in pandemic, you may have been doing a development, and guess what? You weren't even able to get the tradesman onto site. So that's elongated your transaction, which means that you're being put under pressure to actually exit from the finance. You've got options to extend it, and I want to go back to term in a moment because I think that's really important.
Okay.
But you've got the option of maybe refinancing with the same short-term lender, and there'll be fees and different things involved with that depending on the lender. You've got the ability to potentially rebridge that with another lender. You can take that out. Or you may be able to actually even refinance it with the same lender, which is slightly different to actually extending the term. So let's go back to term. I see some deals come across my desk, well, every day, but sometimes the developer, the investor, thinks that they can get out a lot quicker than we feel that they can get out. You know, and if anything that we can learn and glean as an advantage from pandemic is that you probably should be adding time onto your term and taking it for a lot longer than you actually anticipate it. Maybe sales times, you know, maybe someone brings in a mini budget that affects things with exits. All those different things is where most lenders will work on a daily interest basis.
Okay.
So you only pay for in the end what you utilize. But if you have too short a term and you start stressing that and going over, that will be actually a lot more expensive than actually taking it for longer and only utilizing it for maybe half, 3/4 of the time.
I suppose you've got to have that there as an incentive, haven't you, really, to be accurate?
Well, you got to be accurate, because guess what? The reason that some people do it for shorter terms is because they want to net more money out of the deal. Because if you take an interest over a longer period of a term, well, that gross loan is obviously going to be made up of more interest in there. But again, you know, the reason that it's being used and utilized is because you can add true value onto a property. So I have it sometimes said to me, short-term finance, I've heard that's expensive. Well, it's not if it's a considered business cost.
No.
So if I can buy a property for 300,000, put £50,000 worth of works into it, and the GDV, the gross development value, is going to be 600,000, well, you're going to be making profit. but a lot of the time the due diligence is not done on what the costs of works will be. So that's the other consideration. Have you really costed it out?
I think I think you're right. You know, I think the most obvious problem that we hear at Property TV from would-be developers or new developers, people new to the industry, the one thing they forget to take into account is time.
Correct.
They always overlook it. They say, look, it can sell for this, it can sell for that. There's a comparable over there. I've looked at the material cost, and then you say, have you looked at the time this is going to take? Have you made an allowance? And they go, no, why would I?
I was talking about this the other day. So it was the difference between, and it was a reasonably okay investor, but they were actually diversifying. So even though they were experienced in one side, they weren't as experienced in what they were looking to do. And they said, Jamie, would you look at, say, permitted developments versus planning? I said, well, both play their part. But when they had actually showed me what they had there as a contingency to actually spend on the works, and they were looking to buy a property that they needed to go for a plan in play, I said, well, all bets are off. I said, planning could take you up to 6 months to obtain. And if you're costing up the works today for the materials, again, all bets are off. In 6 months' time, those cost of materials could have gone flying up. So those are the other considerations as well. What you want to do.
Today's inflation rate, something that could be huge, couldn't it?
Could be. And the availability of said products as well, and materials.
And labour.
And labour.
I think Brexit's got a lot to answer for.
As we said off camera, I'm apolitical and I won't make any political statements, Stephen.
Okay, well, I think we'll just agree to agree on that one.
We agree. Well, yeah, okay.
Give everybody a clue. Okay, one thing that is interesting me at the moment, we've got quickly rising interest rates. Now, you know, talking to me, you're talking about somebody who's grown up, I think, for the majority of my business life, where it was considered anything under 10% was quite reasonable. And even if it fluctuated up or down 2%, then you shouldn't really be running the business on that kind of tight margin that it makes that much difference. I think you mentioned the expression sort of a recognised business cost. Mm-hmm. So you cost in a sort of margin. How are people going to do that today when we almost have the government fighting the Bank of England? They don't seem to be working as one. You've got the banker saying, well, we're going to have to, you know, put up interest rates to fight inflation. And you've got the government saying, well, we're doing all sorts of things to bring inflation down and we don't need interest rate hikes. So where do we go with this?
Well, we are where we are in the sense of what's just happened. So unless anyone's got a DeLorean and can go back in time, we can't reverse that. We're now left with the situation of, and I totally agree with you, that we've got a lot of investors now that may not have experienced the Norman Lamont years of high interest rates. But that doesn't mean that then we should be able to suck it up and accept that it's maybe where the levels are 5%, whereas a year they were 1% for whatever maybe the borrowing is. Yeah. Because the world has changed since the 80s, the 90s, because people who are holding buy-to-lets that they now need to maybe refinance coming to the end of their fixed deals are now set on the rules which the Prudential Regulation Authority put in, and actually the stress tests are just not there as well. So there is a lot of worry out there in the market, and I know a lot of lenders are working to try and get through that, but we just need to see where this lands, because you know there's going to be subsequent MPC, you know, more, pricing committees out there that may push up the base rate again. Lenders are only reacting based on their cost of funds and what they actually have to price these things for. I don't think there's going to be any intervention by the government, as in, you know, I would imagine you'd ask, can they sort out and help out and something to the mortgage companies? Well, they've actually caused this in a sense. Not that they wanted to cause this, but this is the effect that we're now dealing with. I go back to, I think there's still a lot of opportunity, but it has to be really considered.
Well, I think those of us who've been in the property market for a long time, you do realise that when there's a problem, there's a profit. If you find it.
If you find it.
Yeah, and if you're sensible about what you do. But it does worry me that people, for instance, have perhaps bought 2 or 3 buy-to-let properties. We know that we can't directly put properties into a pension fund, but nevertheless, those 3 or 4 properties can be your pension.
Depending on how you structured it, and you know you're getting good tax advice, and you've got good advisors around you as well that can find those deals, it could form part of that. It could.
But if we have quickly rising interest rates, ones that you can't cater for. I mean, I'm thinking, for instance, if your mortgage costs jump by double at the beginning of a 12-month tenancy, there's not much you can do about it.
You can't double your rent.
You can't handle it. So I just do sympathise with people who are going to get into that sort
Massively.
of situation, and I do wonder whether the government aren't going to have to do something to assist in those circumstances.
So potentially, and some of the rules, and let's see. I'm not going to second guess what they could do next, but landlords have had a kick in for years, haven't they? Through different regulations and different ways. Whereas, let's play this through. If landlords decide to leave the market and those properties come on the market, a first-time buyer is actually able to buy those properties in a cost of living where that's rising and all the costs that they've got at the moment. And we've just talked about the affordability and the rising interest rates for those residential mortgages as well. So this is going to be quite interesting how it plays out.
Well, I think it is. And I mean, I think with the government changing their mind every 5 minutes, I see today we've dropped the housing targets. They've taken off the stress tests for mortgages in a retail situation, haven't they? I just fail to get some of the logic of all this. And I think at the end of the day, it is going to cause, it's going to aggravate the sort of housing crisis in terms of stock and availability, whether that be to buy or to rent. And I think we're going to get in a bit of a mess if we're not careful.
I think a lot can be solved through communication. And what I mean by that is that if the government or the regulator, and they pull loads of the levers they want to do, tell us why they're doing that and tell us what the effect that they think that's going to have. I think that would actually, we may not agree with it, but it may show us what actually their aims are.
It'd allow you to. Yeah.
It allows us to understand. In the same way that if your investors watching this program have got loads of questions, get around the brokers, contact us. We may have different options and solutions that you may not have thought about as well.
Sure.
But there's communication all the way down the chain. It has to be the only way that we can get through this.
Okay, well, on that happy note, Jamie Pritchard, Director of Sales for Glenhawk, thank you so much for coming down and talking to us today. It's been really informative and most grateful. I'm sure to our viewers will be pleased with your comments and advice. So I'm Stephen Galpin. That's all from me today in Property Matters. Join me again next time.